Retail sentiment surveys reflect similar hesitation. Participation is present, but not euphoric. Volatility metrics in precious metals have compressed relative to prior spikes, suggesting options markets are not aggressively pricing upside risk. In structural terms, the positioning backdrop is reset. When macro reversals in yields, dollar weakness, and liquidity expansion converge with neutral or underweight positioning, the setup becomes asymmetric. There is less forced selling overhead and greater potential for incremental capital to re-enter. This is the phase serious observers monitor closely. Not the headline surge, but the quiet reaccumulation. Now we address the bear case. The bear case is real. I am not softening it. The bear case is real. I am not softening it. First, inflation could re-accelerate. Recent CPI data from the Bureau of Labor Statistics show that while headline inflation has moderated from prior peaks, core services remain persistent. If inflation stabilizes above target or turns higher, the Federal Reserve could resume tightening pressure, driving real yields upward and constraining gold's advance. Second, the labor market remains resilient. BLS employment reports continue to show historically low unemployment and steady wage growth. A strong labor backdrop delays rate cuts and supports higher for longer policy expectations, which historically cap precious metals momentum. Third, the dollar could rebound sharply in response to geopolitical shock or global risk aversion. In acute stress episodes, capital often flows back into dollar liquidity, pressuring metals in the short term. Fourth, silver faces industrial sensitivity. ISM and global PMI surveys have shown uneven manufacturing activity. A sustained slowdown in industrial production would dampen silver's fabrication demand. These risks are not hypothetical, they are measurable. Markets are nonlinear and policy error is always possible. So let us strip this down to raw data. 10-year Treasury yield down approximately 60 basis points from its recent peak. U.S. Treasury, July 2026. Move index volatility lower from prior spike levels. ICE BOFA, July 2026. Dollar index down roughly 4% month over month. ICE DXY, July 2026. Fed balance sheet up over $120 billion in 90 days. Federal Reserve H.4.1, July 2026. Reverse repo facility down more than $300 billion year to date. New York Fed, July 2026. Treasury general account balance reduced materially quarter over quarter. U.S. Treasury, July 2026. Global M2 growth turning positive year over year. OECD, Q2 2026. Emerging market reserve gold holdings rising. IMF COFR, Q1 2026. Silver market deficit exceeding 200 million ounces. Silver Institute 2026 report. Solar demand up double digits annually. IEA 2026 outlook. COMEX registered silver inventories down double digits from peak. CME, July 2026. Central bank gold purchases above 1,000 tons annualized. World Gold Council, 2026. PBOC reserves rising consecutively. SAFE, 2026. Managed money net longs reduced materially from highs. CFTC, July 2026. Gold ETF flows stabilizing after outflows. Bloomberg, July 2026. ISM manufacturing near contraction threshold. ISM, June 2026. CPI year over year above target. BLS, June 2026. Real rates off recent highs. Fred, July 2026. Reversals in yields, dollar, liquidity, positioning, all aligned. Every number referenced in this briefing originates from primary institutional sources. Federal Reserve statistical releases, including H.4.1 and FRED databases, U.S. Treasury yield curve data, and Treasury general account statements. New York Federal Reserve reverse repo facility reports. Bureau of Labor Statistics CPI and employment releases. ISM manufacturing and services PMI surveys. CME Group COMEX warehouse and inventory reports. CFTC commitment of traders data. ICE dollar index pricing. World Gold Council quarterly demand trends, Silver Institute annual market report, LBMA Vault Holdings data, Bank for International Settlements liquidity commentary, IMFCO FER reserve disclosures, OECD global monetary aggregates, International Energy Agency solar demand outlook, Bloomberg Intelligence ETF flow data, SAFE disclosures on China's official reserves. Pull everyone, Verify yourself. The philosophy here is simple: transparency over narrative, primary data over headlines, structure over speculation. Now the question for serious observers is direct. Is this reversal the beginning of a sustained metals cycle, or a temporary liquidity head fake before policy tightens again? If your long-term thesis on gold and silver remains intact, write structural in the comments. Not as a slogan, but as a signal to others who are analyzing the same data with discipline. This community is built on primary sources, not headlines. The core thesis is simple. When yields roll over, the dollar weakens, liquidity expands, and positioning resets. Precious metals enter asymmetric phases. Subscribe if you value institutional-grade analysis delivered without narrative distortion. Do not let an algorithm decide whether you see structural signals forming in real time. Share this briefing with one person who understands balance sheets. Stay alert, stay sovereign. This briefing is provided for educational and informational purposes only. It does not constitute financial, investment, legal, or tax advice. I am not a licensed financial advisor, broker, or investment professional. The analysis presented reflects interpretation of publicly available data and institutional reports, which may change without notice. All investments involve risk, including the potential loss of principal. Precious metals, equities, bonds, and other financial instruments are subject to market volatility, liquidity constraints, and macroeconomic uncertainty. Past performance is not indicative of future results. You are solely responsible for conducting your own independent research and due diligence. Consult qualified financial professionals before making any investment decisions. Decisions should be based on your individual financial situation, risk tolerance, and objectives. It is July 2026, and markets have just experienced a sharp reversal in bond yields and the US dollar, precisely the conditions under which silver and gold begin to move with intent. Mainstream coverage calls it volatility. Structural observers recognize it as transition. In this briefing, we are not reacting to price. We are analyzing regime shift. To understand why this matters, we need to step back and look at three facts the market cannot ignore. We know that U.S. Treasury yields have reversed sharply from recent highs, confirmed by Federal Reserve and Treasury data over the past several weeks. We know that the dollar index has rolled over decisively, breaking the momentum that defined the prior tightening phase. And we know that liquidity indicators, specifically the Federal Reserve's balance sheet stabilization and the continued drawdown of the reverse repo facility, are quietly expanding systemic liquidity. Individually, these shifts are notable. Together, historically, they mark the early stages of sustained strength in precious metals. This is not conjecture. Similar alignments preceded the 2001-2003 advance, the 2008-2011 repricing, and the 2019-2020 surge. If this reversal persists, it alters global capital flows, real rate expectations, and sovereign reserve behavior. The implications extend far beyond short-term price movement. We will walk through 7 fractures. The first fracture is happening in the bond market. Over the past 30 days, the U.S. 10-year Treasury yield has reversed sharply from its recent peak, according to Treasury and Federal Reserve data. This is not routine fluctuation. It is a momentum break following an extended tightening cycle. Simultaneously, the MOVE Index, Wall Street's gauge of Treasury volatility, has shifted direction, signaling stress repricing beneath the surface of what commentators describe as a healthy pullback. Historically, these inflection points matter. In 2001, yields peaked months before gold began a multi-year advance. In 2008, Treasury yields collapsed as systemic fragility surfaced, and gold entered a powerful repricing phase. In 2019, a similar rollover preceded the 2020 surge. World Gold Council data consistently show that once real yields peak and begin trending lower, gold tends to lead within quarters, not years. When yields roll over after tightening cycles, it reflects changing growth expectations and capital protection behavior. Bond markets move first. Precious metals follow. But yields do not fall without something breaking. The second fracture is in the dollar. The U.S. dollar index has declined meaningfully from its recent highs, breaking the upward channel that defined the tightening phase. ICE data confirm a decisive rollover, not a single-session anomaly. Historically, the inverse correlation between DXY and gold is persistent and measurable. When the dollar weakens, gold and silver reprice in response, often before equity markets fully adjust. The Bank for International Settlements has repeatedly noted that global dollar liquidity conditions act as a pressure valve for emerging markets. A softer dollar eases funding stress, stabilizes commodity importing economies, and supports higher nominal commodity prices. At the same time, central banks in emerging markets continue diversifying reserves incrementally away from exclusive dollar concentration, according to IMF and World Gold Council data. We saw this dynamic during the 2002 to 2007 dollar bear cycle, when sustained currency weakness coincided with one of the strongest precious metals advances in modern history. But currency shifts alone do not explain what is happening beneath the surface. The third fracture is liquidity. Over the past 90 days, Federal Reserve H.4.1 data reveals a subtle but undeniable expansion in the balance sheet, occurring contrary to official tightening rhetoric. Simultaneously, the New York Fed's reverse repo facility is experiencing a sustained drawdown, draining hundreds of billions from this sterile parking ground and injecting them directly into the circulating monetary base. This is not passive drift, it is active liquidity deployment. Treasury general account balances have also shifted lower, facilitating a net increase in system reserves available to the market. This domestic plumbing mirrors a global phenomenon. OECD and IMF data confirm that global M2 money supply is re-accelerating across major economic blocs after months of strict contraction. Liquidity precedes price. Historically, when stealth easing begins beneath the surface of official policy declarations, precious metals detect the shift months before equity markets adjust their inflation expectations. The 2020 liquidity surge provides the clearest modern precedent. As the Fed expanded its balance sheet and repo operations drained, gold spiked to unprecedented highs within months, validating the transmission mechanism. What mainstream commentators describe as a temporary technical adjustment, structural observers recognize as the reemergence of monetary accommodation. The fuel for the next repricing is already flowing through the system. But liquidity explains gold. Silver is different. The fourth fracture is industrial demand. The fourth fracture is silver's structural deficit. According to the latest Silver Institute annual report, the global silver market has recorded consecutive supply shortfalls, with industrial demand outpacing mine production and recycling flows. This is not theoretical scarcity, it is arithmetic imbalance. The International Energy Agency documents accelerating solar installation growth, and photovoltaic demand now consumes a historically significant share of annual silver supply. Electrification policies are not cyclical, they are structural. On the supply side, primary silver mine output remains constrained by declining ore grades, limited new discoveries, and permitting delays across Latin America. COMEX inventory data further reveal steady drawdowns in registered silver stocks, tightening the immediately deliverable pool. Silver occupies a dual identity, monetary hedge and industrial input. When monetary demand converges with industrial consumption during periods of constrained supply, price sensitivity increases exponentially. Observers who remember the 2010-2011 silver repricing understand how quickly deficits can transition into disorderly moves. But deficits matter only if physical tightness shows up. The fifth fracture is physical market stress. The fifth fracture is the divergence between paper pricing and physical reality. COMEX data show registered silver inventories trending lower relative to recent peaks, tightening the pool available for immediate delivery. At the same time, LBMA vault flow reports indicate fluctuations that suggest metal is moving, not sitting idle. In Asia, import premiums for physical bullion periodically expand above spot, signaling localized scarcity even while futures markets project calm. ETF flows add another layer. Periods of outflows in Western funds often coincide with steady physical offtake in Eastern markets. Mainstream commentary interprets ETF redemptions as weakening demand. Structural observers recognize metal frequently migrates from leveraged paper vehicles into private custody. Price stability in futures markets does not automatically reflect abundance in physical markets. Futures contracts can expand infinitely, physical supply cannot. The divergence does not always resolve immediately, but history shows it eventually compresses through price. Mainstream sees temporary consolidation. Observers see gradual structural drawdown. But the largest signal is not retail positioning or ETF flows. It is central banks. The sixth fracture is sovereign accumulation. World Gold Council data confirm that central banks have been net buyers of gold at levels not seen in decades. This is not symbolic diversification, it is balance sheet reallocation. The People's Bank of China has reported consistent additions to official reserves, while several emerging market central banks across Asia and the Middle East continue incremental purchases, according to IMF and National Reserve disclosures. This trend is occurring alongside renewed discussion among BRICS nations regarding alternative settlement mechanisms for cross-border trade. While headlines frame these discussions as political signaling, reserve data tell a quieter story. Sovereign entities are incrementally hedging exposure to a dollar-dominated system. There is precedent. In the 1960s, persistent gold outflows from U.S. reserves signaled eroding confidence in Bretton Woods long before the formal break in 1971. Gold moved before policy admitted strain. Central banks do not chase momentum. They hedge structural risk. When sovereign balance sheets shift toward gold during periods of dollar volatility and yield reversals, the signal deserves attention. But even that is not the sharpest signal. The seventh fracture is positioning. CFTC, Commitment of Traders data, show that managed money net long positions in both gold and silver have been reduced materially from recent highs. Speculative excess has been flushed. This matters. Sustained advances rarely begin from crowded trades. They begin from skepticism.